All right, so we're diving deep into CESC Limited today, and you sent over a ton of info, huh?
Yeah.
Financial statements,
Mm-hmm.
audited reports, even their internal rule book on corporate governance.
Mm-hmm.
Looks like someone's on a mission to really understand this company, and we're here to help.
Yeah, it seems like you want to go beyond just like the headlines and really figure out, is CESC as healthy and well managed as they appear? Is this a company that, you could confidently invest in, or are there some red flags lurking beneath the surface? That's really the question that I think we'll be exploring today.
Yeah, I love that. A financial mystery waiting to be solved. But first, a quick recap, I guess, for anyone who needs it. CESC Limited is a big name in the Indian electric utility sector. They're based in Kolkata, handling everything from power generation to distribution.
And here's the thing. They're a publicly traded company on the Indian stock exchanges.
Yeah.
And that means they're playing by a whole set of rules that are designed to keep things transparent and fair for all investors. Those rules around insider trading will be particularly interesting to examine later on.
Right. No funny business allowed.
Exactly.
So let's kick things off with that juicy dividend announcement. CESC declared an interim dividend of INR 4.5 per share, which sounds pretty generous, right? Does this automatically signal a thriving company, or are we getting ahead of ourselves?
Well, think of it this way. A company wouldn't be sharing its profits with shareholders unless it was feeling pretty confident about its financial situation. So declaring a dividend is usually a good sign, but it's just one piece of the puzzle.
Okay, so we can't judge a book by its dividend cover, right? Crack open those financial statements and see what's really going on. I'm seeing revenue is up year over year. Profits are also looking good. Things seem to be moving in the right direction. But I know you always say it's not just about the numbers themselves, but the story they tell.
Exactly. What's fascinating here is that while CESC's revenue and profits are indeed up, their net profit margin has actually shrunk a bit. In other words, they're making more money overall, but they're keeping a slightly smaller percentage of each rupee earned as profit. That could point to some underlying issues.
Intriguing. So what could be driving this shrinking margin? Is it like a canary in the coal mine or just like a normal fluctuation?
It's worth investigating. Maybe their costs are rising faster than their revenue. For example, the cost of fuel, which is a major expense for power generation companies, has shot up significantly. Think of it as like their massive power plants getting hit with a hefty grocery bill.
Makes sense. And remember that regulatory income we talked about?
Yeah.
That's like a bonus they get for following the government's rules. Could changes in regulations be affecting their bottom line?
Absolutely. Regulatory changes can have a huge impact on a company's profitability. It's like playing a game where the rules keep changing. You have to constantly adapt your strategy.
Right.
You know?
Yeah, totally. Speaking of adapting, let's bring in the independent auditor's perspective. They've done a limited review of CESC's financials, which is like a quick checkup, not a full-blown surgery.
Right.
So how much weight should we give their opinion?
Yeah, it's valuable input, but it's important to understand its limitations. A limited review means they haven't scrutinized every single transaction. They're looking for any glaring red flags, but they might miss some of the finer details. Think of it as getting a second opinion from a doctor.
Yeah.
Okay. It's not the be-all, end-all.
Well, they did flag a couple of things that made me raise an eyebrow. First, their depreciation calculations seem unusual. They're adding back depreciation due to the increasing value of their assets. Is that normal accounting practice?
It's not the most common approach. Depreciation is usually an expense that reflects the wear and tear on assets over time. So adding it back suggests that CESC believes those assets are actually appreciating in value, maybe due to market conditions or upgrades. But it could also be a way to artificially inflate their profits.
Interesting. So they're basically saying, hey, our power plants are like fine wine. They get better with age. But it does make you wonder if that optimism is warranted.
Exactly. We need to consider whether this depreciation strategy is a clever accounting move or a risky gamble. What happens if the value of those assets suddenly drops?
Yeah. And the auditors also pointed out those ongoing disputes CESC is having with regulators, particularly around power purchase agreements and tariff orders.
Yeah.
Sounds like potential trouble brewing.
Definitely something to keep an eye on. These disputes can drag on for years and can have a big impact on a company's financials. They often boil down to disagreements over pricing and terms of service, and if they're not resolved favorably, it could mean lost revenue and lower profits for CESC.
Right, so we're seeing this interesting contrast. On the surface, CESC appears financially healthy. They're sharing profits with shareholders. Revenue is up, profits are up. But a closer look reveals some potential cracks in the foundation. Rising costs, unusual accounting practices, regulatory disputes. It's like they're trying to walk a tightrope.
Yeah, that's a great analogy, and that's what makes this deep dive so compelling, right? We're getting beyond the superficial numbers and starting to understand the complexities of CESC's business. It's like peeling back the layers of an onion. Who knows what we'll find at the center?
Okay, ready to switch gears and delve into the fascinating world of corporate governance. I always find these internal documents so intriguing. It's like getting a peek behind the curtain at how a company really operates.
Absolutely. It's particularly relevant in this case because we're looking at their policies and procedures for preventing insider trading. It's all about ensuring a level playing field for all investors, big or small.
Yeah. And the first thing that jumps out is their definition of designated persons. It's not just the CEO and top executives. We're talking about a huge list of people. Assistants, finance folks, IT staff, even family members.
Yeah.
If they have access to sensitive information that could give them an edge in the market, they're on that list, subject to strict trading restrictions.
Right. And that's crucial because insider trading isn't just about, you know, high-level executives making shady deals. It's about anyone at any level who might be tempted to use their knowledge for personal gain. So having that wide net is really important.
And to prevent that, CESC has implemented these trading plans where designated persons have to schedule their trades in advance. It's like saying, look, I planned to buy these shares months ago, so it's not based on any insider info I just got.
It's all about creating a clear paper trail and demonstrating that their trades are predetermined and not based on any recent, non-public information.
Right.
It's all very, above board.
Yeah. Then they have these trading windows, specific periods when designated persons are allowed to trade. It's like a game with very strict rules about when you can make your move.
Exactly. The idea is to prevent people from trading based on information that hasn't yet been made public.
Right.
It's all about maintaining fairness and transparency.
And get this, they even have procedures for handling leaks of sensitive information. They've got this inquiry committee that swoops in to investigate potential breaches. They're not messing around.
Yeah, what's fascinating here is the level of detail and complexity in these internal policies. It really shows just how difficult it is to prevent insider trading in a large organization where so many people potentially have access to sensitive information.
Right. It's a constant cat and mouse game.
Yeah.
But I have to say, this level of diligence does give me a bit more confidence in CESC's commitment to ethical behavior.
Yeah, agreed. In today's business world, corporate governance is paramount. Investors are increasingly looking beyond the financials and scrutinizing a company's ethical practices.
All right, ready to shift gears again. Let's explore CESC's strategic moves in the market. They've been making some bold acquisitions and expansions, and I'm curious to see how those fit into the bigger picture.
Certainly, let's delve into that.
Welcome back to our CESC Deep Dive. Ready to roll up our sleeves and dig into the nitty-gritty of their financials?
Absolutely. Let's see what these numbers reveal about CEC's performance. Sometimes the raw data can tell an even more intriguing story than the summaries.
Okay, looking at their standalone financials, that's just CESC itself. Without all the subsidiaries, their income from operations for the third quarter of 2024 was 2,169 crore rupees.
Huh.
Now, I know it's a huge number, but what does it actually tell us?
Well, it's important to remember that a crore rupee is 10 million rupees, so we're talking about a significant amount of revenue generated from their core business activities.
Right.
However, that number is actually down by 26.6% compared to the previous quarter.
Oh, 26.6. That's a pretty steep drop. Makes you wonder what happened there. Was it something specific to that quarter, or is there like a bigger trend we need to be aware of?
That's the million rupee question, isn't it? It's crucial to compare these numbers to previous years and quarters to see if this kind of fluctuation is normal for their industry, or if it's a red flag signaling deeper issues.
Good point. And their total income for the quarter, which includes other sources besides their main business, was 2,260 crore rupees.
Okay.
Again, a hefty sum, but down about 26% from the previous quarter. So it seems like that downward trend wasn't just limited to their core operations.
Precisely, it affected their overall income as well.
Right.
This suggests that we need to dig a bit deeper and figure out what factors might have contributed to this decline across the board.
All right. Let's zoom out a bit and look at the consolidated financials. Now, this includes CESC and all of its subsidiaries together, so it gives us a much broader perspective on their overall performance. Their total consolidated income for the quarter was a whopping 15,544 crore rupees.
That's a massive jump compared to the standalone numbers. It really highlights the collective power of CESC and its subsidiaries.
Right.
It also underscores why it's so important to look at both standalone and consolidated statements. You get a much more complete picture of the company's financial health.
Totally agree. But here's the thing. Even with that massive consolidated income, we're seeing the same pattern. Their total income for the third quarter of 2024 was still down about 26% from the previous quarter.
So it wasn't just a standalone blip.
Right.
This consistent downward trend across both standalone and consolidated statements suggests a broader issue potentially impacting the entire group,
Okay.
rather than isolated challenges within a specific subsidiary or business unit.
Okay, time to talk profit. CESC's standalone profit before tax for the third quarter was 231 crore rupees.
A respectable figure, but let's put it into context. It's actually down by approximately 17.2% compared to the previous quarter.
So we're seeing a decrease in profit alongside the decrease in revenue. That's not entirely surprising, but it does raise some concerns about their profitability.
Absolutely. This decline suggests potential pressure on their margins, meaning they're making less profit for every rupee they earn.
Right.
We need to figure out if this is just a temporary blip or a sign of a more concerning trend.
And what about their consolidated profit? Is it showing the same pattern?
Yes, unfortunately, their consolidated profit before tax for the same quarter was much higher, 1,683 crore rupees, reflecting the combined earnings power of all those subsidiaries. But we again observe a decline of around 17.2% compared to the previous quarter. This recurring pattern of decline across key financial metrics certainly warrants a closer look into their operational efficiency and any external pressures they might be facing.
Okay, let's step back even further and look at the bigger picture, the full 9 months leading up to December 31st, 2024. CESC's standalone income from operations for this period was 7,898 crore rupees, with a total income of 8,106 crore rupees.
Now, these numbers tell a slightly different story compared to the quarter-on-quarter analysis.
Right.
Their standalone income from operations actually increased by approximately 11.9% year over year,
Oh.
and their total standalone income, up by about 12.3% compared to the same period last year.
So they were doing pretty well for most of the year, then hit that speed bump in the third quarter, almost like they were sprinting, then tripped and stumbled a bit.
A good analogy. And the consolidated numbers for the 9 months show a similar pattern. Their income from operations was 26,633 crore rupees, with total income hitting 28,197 crore rupees.
Again, massive numbers. And their year-over-year growth isn't too shabby either. Their consolidated income from operations for the 9 months increased by about 8.2%, and total consolidated income was up by 9.5% compared to the same period last year.
Right, so even with that third quarter slowdown, they're still showing solid overall growth for the year,
Right.
which makes that third quarter dip even more curious, wouldn't you say?
Totally. What could have happened in that specific quarter to cause such a noticeable dip? It seems like there must have been some unique factors at play.
It could be a perfect storm of things, industry-specific events, regulatory changes, maybe even some internal challenges they were dealing with.
Right.
That's where a deeper dive into their quarterly reports and management discussions would be helpful.
Yeah. Let's not forget about the profit numbers for those 9 months. CESC's standalone profit before tax was 784 crore rupees, up by roughly 8.9% year over year.
Okay,
It's a pretty healthy growth rate.
indeed. But when we look at the consolidated profit before tax for the 9 months, we see a slightly different story. It stands at 1,919 crore rupees, but this actually represents a year-over-year decrease of about 1.5%.
Hold on, so their standalone profit is growing, but their consolidated profit is shrinking. That's pretty counterintuitive. Are the subsidiaries dragging them down?
That's a very astute observation. This discrepancy in profit trends between standalone and consolidated numbers suggests that we need to pay closer attention to the individual performance of CESC's subsidiaries.
Okay.
Some might be thriving, while others could be facing headwinds that are impacting the overall group's performance.
Okay, now for the grand finale, the net profit margin. This is the number that tells us how much profit they're actually keeping for every rupee of revenue they generate. Kind of like their profit efficiency rating.
Exactly. It's a key indicator of financial health and operational efficiency.
For those 9 months leading up to December 31st, 2024, CESC's standalone net profit margin was 7.71%. Not bad, but down slightly from 8.29% in the same period last year.
Okay, so that slight decline in the standalone net profit margin suggests that their costs might be increasing faster than their revenue, which puts pressure on their overall profitability.
And their consolidated net profit margin for those 9 months was 7.17%, also down from 7.86% the year before. So it seems like that margin shrinkage is happening across the board.
Yes, the shrinking margin at both the standalone and consolidated levels reinforces the idea that some subsidiaries might be facing profitability challenges.
Right.
It also raises an important question. Are their cost-cutting measures effective, or do they need to explore other avenues to improve their margins?
Right, we've crunched a lot of numbers. What's the key takeaway for our listener who's been patiently following along?
Well, we're seeing a complex picture emerge.
Right.
CESC, on its own, seems to be navigating the year fairly well, with decent year-over-year increases in revenue and profit.
Okay.
But that third quarter dip in performance is a definite head-scratcher.
Right.
And when we factor in their subsidiaries, things get even more nuanced.
Right, it's like a financial mystery novel. The overall group is showing growth, but those shrinking profit margins and the year-over-year decline in consolidated profit before tax suggest that some of those subsidiaries might be weighing them down.
Precisely. It highlights the importance of not just looking at the top-level numbers, but also delving into the performance of individual business units.
Right.
A company's success, or lack thereof, is often driven by the sum of its parts.
Makes sense.
Yeah.
So to truly understand CESC's long-term prospects, we need to peel back another layer of the onion and examine those subsidiaries more closely, right?
Absolutely. We need to figure out who the star performers are and who might be struggling. Thankfully, our listener has provided us with a treasure trove of information on CESC's subsidiaries, so we're well equipped to uncover those hidden gems and potential trouble spots.
Perfect. Let's take a break. When we come back, we'll dive into the exciting world of CESC's subsidiaries and explore the strategic moves they're making in the energy market. Stay tuned. Hashtag TTS The Deep Dive, episode 2025 A110, part 3 of 3.
All right, welcome back to our CESC Deep Dive. We've explored their financials, peeked behind the curtain at their corporate governance practices, and now it's time to, zoom in on those key players within the CESC universe, their subsidiaries.
Yes, CESC isn't just a single company. It's a whole network of interconnected businesses operating across various segments of the energy sector.
Right.
Understanding their individual performance and strategies can give us a much richer understanding of CESC's overall direction and potential.
So let's play a game of subsidiary spotlight. Which one caught your attention first?
One that immediately stands out is Eminent Electricity Distribution Limited.
Right. Their recent acquisition of a 100% stake in the power distribution company for the Union Territory of Chandigarh is a significant move.
Right. That's like taking a giant leap onto the national stage, right? They're not just a regional player anymore.
It's a bold statement, and it shows their commitment to expanding their reach and solidifying their position in the power distribution market.
Right.
This could be just the beginning of a much larger expansion strategy.
Speaking of bold moves, we can't forget about Perva Green Power Private Limited, or PGPPL for short.
Right.
They've been on a roll, incorporating new subsidiaries and scooping up other companies like it's a shopping spree.
Their aggressive growth strategy definitely suggests a laser focus on the booming renewable energy sector.
Yeah.
They're clearly positioning themselves to be a major player in this space, and they're not wasting any time.
It's like they're building a green energy empire, brick by solar brick. And their recent acquisitions of Disraj Solar Energy Private Limited and Budraj Renewables Energy Private Limited tell us they're serious about dominating the solar market.
Oh, absolutely. These acquisitions not only bring in established projects and a wider customer base, but also valuable operational expertise.
Right.
It's a smart way to gain a foothold in the solar energy domain without having to start from scratch.
But they're not just relying on acquisitions, right? PGPPL is also busy creating new subsidiaries from the ground up.
Yeah.
They've launched 3 new ones just this quarter.
That's another smart move.
Yeah.
By incorporating new subsidiaries, they can enter specific niche markets within the renewable energy sector with greater agility and focus. It's like having specialized teams tackling different pieces of the renewable energy puzzle.
And it allows them to manage their risks and resources more effectively.
Right.
One subsidiary might focus on solar farm development, while another specializes in wind energy, for example.
Precisely. This multi-pronged approach, combining acquisitions with organic growth, shows a well-thought-out strategy for building a strong and diversified presence in the renewable energy landscape.
Right.
They're covering all their bases.
Okay, so we've got CESC making waves in both traditional power distribution and the exciting world of renewable energy. They're juggling multiple strategies, expanding their reach, and diversifying their portfolio.
Hmm.
What does this all mean for our listener who's been trying to, you know, decipher the CESC puzzle?
Well, it means CESC is a company in transition. They're evolving from a traditional utility company to a more dynamic and multifaceted energy player.
Right.
They're embracing the future, but they're also, balancing that with their existing strengths and established business lines.
And that transition comes with both opportunities and challenges, right?
Yeah.
Can they successfully navigate this shift and emerge as a leader in both the traditional and renewable energy sectors?
Yeah, that's the big question. Their success will depend on a number of factors.
Hmm.
Their ability to execute these ambitious plans, adapt to the ever-changing regulatory landscape, and stay ahead of the curve in a rapidly evolving industry.
Right. It's a high-stakes game, but it seems like they're playing it strategically.
Absolutely. And for our listener, this deep dive has provided invaluable insights into CESC's financial performance, corporate governance, and strategic direction.
Yeah.
You've now got the knowledge to make informed decisions and continue exploring this fascinating company's journey.
We've uncovered some potential red flags, some exciting growth opportunities, and a whole lot of strategic complexity. But as with any deep dive, there's always more to learn.
That's the beauty of exploration. It's never truly finished.
Right.
We encourage you to stay curious, keep asking questions, and continue your own research into CESC Limited and the broader energy sector.
Yeah, and who knows? Maybe we'll revisit CESC in a future deep dive and see how their story is unfolded. Until then, thanks for joining us, and may your knowledge be powerful.